Hey, what's up, everybody? So today I'm going to be talking about a cheat code that you can use to trade in the stock market. A lot of people don't talk about this as a cheat code, but really, the more I learn about options, the more I understand options, the more I realize this really is a cheat code if you can use it well. So today I want to look at this article, and I want to use this article as a way of sort of introducing you to why I think this strategy is so effective. And I know there's going to be a lot of opinions, a lot of thoughts that are counter to what I believe, but hear me out. If you stick around, I think perhaps you'll gain something from today. Okay, so there's a news article that I saw from Yahoo Finance talking about the 15 most volatile stocks to buy now. Okay, so normally when you hear volatility, or when some people hear volatility, that's not something that you want to kind of veer towards, right? Because you want stocks that tend to not move as quickly. But if you're a little more, if your appetite for risk is higher, then you would be excited about this kind of stuff, right? But today, what I want to talk about is why certain stocks, if you do this specific strategy, you're going to make a lot of money. Okay. And it's almost like a cheat code. Okay. And at the end of this video, I'm going to talk about one specific stock that I am exercising this cheat code on, and then just show you why I think it's such a good trade. Okay. So stick around and you'll see what kind of trades I'm making myself. Hey guys, if this video provides any kind of value to you, I would greatly appreciate if you could hit that like button just so that I can share this with more people. And make sure to subscribe if you haven't already. Thank you so much, and now back to our video. Okay, so the 15 most volatile stocks, starting with Cassava Sciences. Okay, so biotechnology firm developing drugs for neurodegenerative diseases. They have apparently a lot of things in the pipeline. You could do your own research, right? So today, we're not going to necessarily talk about the fundamentals or what stock to own, but we're just going to take a look at how companies, how you can make a lot of money selling options. Okay, so the option we're talking about today is simply selling put options, but specifically with a longer expiration date. Okay, a lot of people have asked, well, why do you, sell expiration dates for so long? When you have your capital tied up, right? That's the first thought. A lot of you may say, well, I don't have a lot of capital and I don't want to tie that up. And that's where I would say, that's why it's so important for me to talk about IKBR, so Interactive Brokers. I'm really not sponsored by Interactive Brokers. Although if you want to sponsor me, Interactive Brokers, hit me an email, and I would love to kind of work something out. But the reason why I use, Interactive Brokers is because they have something called margin, and I know a lot of people have perhaps heard of margin. They're like, "Oh, it's too risky. I don't want to trade on margin." But when you're trading at 1.59%, that is insane, right? Compared to inflation, you're basically going to get an incredible deal on interest rates if you're trading at 1.59%. Now, of course, are there still risks? Yes, there are definitely still risks. But if you're able to manage these risks, then you're going to do really, really well. And in order to manage risk, I think you have to stick around to the end of this video. Okay, so this is not any kind of financial advice. This is simply something that I'm learning myself and that I've been implementing myself. And take a look for yourself as well. Okay, look at the rates compared to E-Trade, Fidelity, Schwab, TD America, all these huge brokerages that also have margin, right? The interest rate is very, very different. Interactive Brokers definitely beats all the competitors by a whole lot, and if your portfolio is larger, then your interest rates gets even lower. But this is a really, really important factor because when you're investing, and especially when you're selling put options, you're going to have a lot of capital tied up. But if you're able to borrow off of your positions, which Interactive Brokers does, meaning that if you have $100,000 in stocks, you can borrow off of those positions. If you have $100,000 tied up in collateral, you can borrow off that positions. And this is such an important tool, especially for trading options. And a lot of people have talked about, well, 2022, I don't know how the returns are going to be. It's not going to be nearly as good as 2021. Well, take a look yourself, right? Take a look at these returns, especially if you find a stock that you really, really want to own and you wouldn't mind holding for long term. But let's go back to the list. So we're taking a look at Cassava Sciences. So right now, Cassava is trading at $48.57. Let's see what you would do, what would happen if you sell a put. Okay, so if you don't know what put option is, it basically just means that you're willing to buy the stock at the strike price you set if it falls to that price. Okay, so we're going to sell what I call a leap option put. Okay, so it's just a put that expires a year or more out. And yes, while your capital will be tied up, you can close out this position anytime by buying it back. Okay, so let's just take a look at a $45 mark, right? So right now, if you open up Cassava Sciences at $45, you are getting paid, my friends. You're getting paid $2,475, okay, to open up this trade, right? And if it does get assigned, yes, you have to buy 100 shares at $45, but you do the math, right? If you're already getting paid $2,475 on premium just to open up that trade, right? In order for you to start really, actually making a loss, the stock would have to fall down by 58%. Okay, now, a lot of you are asking why. Well, it's because you already got paid more than half of the cost of the stock to buy 100 shares at $45. You're getting paid more than half just to open up that trade. And then if the stock continues to go down past negative 58%, then you're going to start realizing a loss. Okay, so I don't know about you guys. I'm trading live right now, by the way. This is something that that you can buy as of right now, or can sell as of right now. And I don't know about you guys, but that is insane, right? Like, this is a trade that is almost like a cheat code, right? Like yes, you're gonna have maybe like you're basically gonna have like $2,000 tied up in collateral because you're getting paid $2,500 to open up that trade. Okay, so you're getting paid more money than you would you're getting paid more money on the premium than the collateral that you would have to hold if you were to open up that trade. Okay, so let's take a look at another stock. So maybe you're not so sure about Cassava. They do have some concerns. You can take a look at that. Let's take a look at Riot, right? So if you're bullish on cryptocurrency and all the everything that's surrounding mining crypto, so let's take a look at Riot right now. Okay, so we're gonna look at Riot Blockchain, and we're gonna go to sell put options. So we're gonna set the expiration date out to January 2023, and let's do the expiration date. Let's do the strike price at $20. Okay, so right now you're basically saying that, okay, all right, so I'm willing to buy Riot if it falls down to $20, but because I'm selling the put option expiring January 2023, I'm getting paid $745. Okay, off of risking, $1,255. So what that means is, yes, I would get assigned if Riot falls down 6%, but I would start realizing loss only if it falls by more than 39%, right? If we're talking about if there's a market correction, if things get really, really bad, then yes, like you might start realizing profit, but the stock would have to fall down about 41% before you start to really lose out or lose money on this trade, right? It's just the premium you're collecting is so much versus how much collateral is tied up. Yes, you are getting tied up by $1,255, but you're getting paid so much premium to open up that trade. Okay, so if you are bullish Riot, if you really want to own Riot, instead of selling these put options where expires like a week out or 2 weeks out, let's take a look at this, right? So right now, if you open up this trade at $20, same thing, you get paid $66, right? and then you have you have to have collateral of almost $2,000. To me, it's not really worth it, because if it does fall, then you're gonna get assigned, and you're not gonna get the stock at such a discount price because of the premium that you collect. Okay, you're only getting paid $66 to open up that trade. Okay, so let's take a look at a couple more. SPCE, Virgin Galactic Holdings. This is actually a great stock to consider, especially given that it's fallen today. So it's down 15% today. So let's take a look at what will happen if we sell a put that expires a year out. Okay, so we're gonna set the expiration date. We're gonna sell a put. So let's say we're willing to buy this stock if it falls another, if it continues to fall down to $10, right? So we would get paid, $330 off of, collateral of $670. That's basically over half, right? Well, about half. Okay, so yes, I will get assigned if it continues to fall by another 5%, but I will only start really losing money on this trade, okay, after I get signed, after it falls 35%. Okay, so if you're bull SPCE and you really want to own these shares, this would be a great option to have. And the one thing to note too is, let's say there's a complete reversal and SPCE turns around and actually jumps up, right? You can close out that trade and you can still realize a profit, right? Because at that point your contract will be worth more than what it is today, because the stock has shot up, and at that point you can close it out for a profit, and your collateral would be released, right? So I really don't, guys. I don't really see why more people are not doing this trade. Comment below if you have any thoughts on this trade and why you might not want to do these trades. I would love to hear your thoughts as well. Okay, so let's take a look at. Okay, I'm not really a fan of XPEV. Don't hate me for that. I just think there's some issues that may come up with that. Let's take a look at Wish. Okay, so Wish stock. Okay, so Wish stock, context logic, today is down a little bit. Okay, so we're going to sell a put option that expires all the way out January 2023. Okay, we're going to say we're willing to buy the share at $2.50, but we're going to get paid a premium of $97, right? So the stock would have to go down about 43% for us to really start losing money on this trade. Okay, but we're getting paid so much premium, and a lot of times how this works is, even if it falls down to the strike price, so even let's say it goes down to $2.50, a lot of times the option holder might not actually assign it, because they even though it's they can, they may not, and so that's something that is very likely to happen as well, and that's something that what makes this such a good trade, because you're getting paid a premium and you only have to have collateral of $153. Okay, so in my opinion, this is a great strategy to trade, because there's so much room for a stock to go downwards, right? That just, to me, it's a no-brainer. Let's take a look at NEO. I do have some shares in NEO. I did a lot of these long sell put options for NEO, and so I want to show you what NEO looks like today. So it is down about almost 1%. So let's say we're willing to buy NEO at $30 if it falls down $30, and we're opening this trade at January 2023. So our max profit, so we collect $645 off the bat. We have to have collateral of $2,355. So that's still a pretty good trade. If NEO goes down another 4%, we may get assigned, but it has to go down another 24% for us to really start losing money. Okay, so because the stock has to continue to go down even after we get assigned, because of the premium we collected, right? So these are, just actual holdings that I'm even holding myself. Let's take a look at Affirm. Okay, so this is actually something I'm considering heavily as we speak. Okay, so Affirm is a technology company. And so, digital, mobile first e-commerce. And so we're taking a look at Affirm. It's trading at $76.93. Let's go ahead and open up our put option, expiring January 2023. And let's say we're willing to buy Affirm if it falls down to, and we don't even have to do it at the strike price underneath. Let's say we're we'll only buy Affirm if it falls down to $70. Okay, so we're still gonna get a pretty good premium. So we're getting paid $1,780 off of a collateral, having collateral for about $5,000. If you do the math, guys, that's still a really good return. I can't do the math off the top of my head, but I believe that is over 30%. And if you think about it, 30% return off of this trade is incredible. Even if you only made 30% in the year, that's still incredible, guys. And so, so let's see how this works, right? So if the stock moves down by another 8.9%, yes, we make it assigned, but the stock would really have to move another 32% downwards for us to start really losing money. And in my opinion, I don't think Affirm's going to go down all the way down to 30%. Okay, so do these on stocks that you really want to hold. Let's take a look at a couple more. Let's take a look at AMD. Okay, so AMD today, let's see how much you're trading at. So AMD, okay, the famous semiconductor microchip business. Okay, let's trading at $138 today. We're gonna sell put options expiring a year or more out. Okay, if you did it even to January 19, 2024, you could do that as well. The premium would increase. Let's just set it out for a year, and we're gonna do it. So, well, let's see how much we can collect on 2024. Okay, just to make things a little more interesting. So right now, okay, if you open up all the way out to 2024 on AMD, okay, this is a stock I definitely would not mind owning. Yes, if it falls down there 6%, you may get signed, but AMD would have to fall about 27% for you to start, having unrealized losses because of the premium you collected. You're collecting almost about 30% on AMD. That is insane, guys. 30% AMD. No matter if AMD trades sideways, if it doesn't go up that much, if 2022 is not a great year for stocks, and if you're making 30% returns on your portfolio, you're gonna do great, guys. It's gonna be really good for your portfolio. Let's take a look at maybe one more stock. Okay, so Tesla. I know a lot of people are doing this strategy, perhaps on a put that expires a little sooner. But let's just take a look at Tesla. Okay, so Tesla today is trading at $1,100, so it's down a little bit. Okay, so let's do a put option that expires January 2023, and let's say we're willing to buy Tesla. Let's go down even further down. Let's go down all the way to $1,000. Okay, so today, if we open this trade, okay, we can collect $20,000, and we're risking essentially $80,000 because if we're gonna sign, we have to pay $100,000. But we would collect a premium of $20,000. So we're making, guys, over 20% on this trade, right? 20% on Tesla, no matter if it goes down or up. And for us to get assigned, the Tesla will have to go down another 9%. And then for us to really start losing money, Tesla will have to go back all the way down to $795. So, guys, if you have a large portfolio, this is really a no-brainer trade to me, right? If you're especially if you're bullish on Tesla, you're just collecting so much premium for the amount of money you are risking, right? And yes, while you can use that money on different stocks, in my opinion, guys, if you're making 20%, 30% returns on your portfolio, you're already doing great. There's no need to try and be a hero and make so much more. I would be perfectly happy if every year I made 20% on my portfolio. Okay, so I hope you guys like this content. If you want me to make more videos like this, make sure you smash out that like button for the YouTube algorithm. Comment below on what your thoughts are on selling puts so far out and collecting so much premium. Until next time, guys, I will see you around in the next video. Today, I sold puts, okay, on SoFi. Okay, so I just sold it a year out at the $12.50 mark. I'll be super happy if I can get SoFi at $12.50, and I'm getting paid a premium of $338. So, guys, that is over 30% return. I'm very happy if I can own SoFi at a 30% return if it goes up. I make 30%. And then if not, then you know that's totally fine. I'll just get assigned, and I'll be perfectly happy with that. Okay, so yeah, that's it.
With every star, we are born again. Open your heart, spend less time in your head.